Do you know what is meant by inflation in finance? Inflation in finance is the steady increase in prices for goods and services, reducing the purchasing power of money over time. It is commonly measured by the consumer price index, affecting investment returns, corporate margins, and daily living costs. Key drivers include high demand or rising production costs, often managed by central banks through interest rate adjustments. Money held in cash loses value, meaning $100 today buys less than it did a year ago. While high inflation can erode bond returns, certain assets like stocks, real estate, and commodities may hedge against it, as their nominal value may rise. Businesses combat inflation by adjusting prices, managing supply chains using financial hedges like fixing interest rates on debt and reducing costs to protect profit margins. Central banks like the Federal Reserve or Bank of England typically raise interest rates to cool down an overheating economy and curb inflation. The inflation rate, often measured by the IMF using CPI, indicates the percentage change in the cost of a basket of goods. Maintain investments in stocks or real estate as they historically outperform inflation. Utilize high yield savings accounts or certificates of deposit to get better returns on cash. Review expenses frequently to account for rising costs of goods, services, and utilities. Lock in fixed rate long term loans if inflation is expected to rise further.